Stop. Before you touch that sell button, before you let the noise from the forums convince you that this move is over, stop. Because what just detonated in the silver market on Saturday, February 28, 2026, is not a spike. It is not a fluke. It is the starting gun of the most consequential rally window this metal has ever been handed. I know some of you are nervous. You saw the run from $87 all the way to $94.30 in a single session, and something in your gut says it can't hold. They want you to believe this is purely a fear trade. They want you to think smart money is already selling into your hands. They are wrong. In fact, they have never been more wrong. It is Saturday, February 28, 2026. Silver just posted a surge of 7.67%, its largest single-session advance since the January record highs. Ladies and gentlemen, analyst here. You need to understand what this means. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let us begin with the architecture of what just happened beneath the price surface. Because the number $94.30 did not appear from nowhere. It was built, brick by brick, level by level. Start at the bottom of the recent structure. According to exchange settlement data, silver carved its February low at $71.76 on February 2, 2026. That level represented the left shoulder of a rebuilding phase, a compressed foundation where physical buyers absorbed every ounce that paper traders threw overboard. From that $71.76 anchor, the metal began constructing a series of higher lows: $81.67 on February 2nd, $86.28 by February 23rd, $87.87 on February 24th, $92.06 on the morning of February 27th as per market data trackers. Each of those higher lows is a rung in the ladder. Each of those bounces is proof that the buying force beneath this market is structural, not speculative. The weak hands bled out somewhere between $81 and $87. The tourists who chased the January all-time high at $121.62, they are gone. What remains are the diamond hands, and on February 28th, those diamond hands got their reward. The session opened with the news that 2 coordinated military operations had commenced in the Middle East. The moment that geopolitical detonation registered in the derivatives market, silver did not hesitate. According to market settlement data, COMEX futures for the active contract surged 7.67% to reach $94.30. The spot market settled at $93.83. That gap, futures ahead of spot, is a classic signal of momentum loading into the next session. Now describe the pattern anatomy in words. The left shoulder of this formation was constructed between February 2nd and February 14th, as silver held above $71.76 repeatedly and refused to break lower. The head, the lowest emotional capitulation point, was the brief test of lows in early February before the structural recovery began. The right shoulder formed across the February 20th through February 27th consolidation range, where silver churned between $86 and $93, compressing energy like a spring being wound tighter with each passing hour. The neckline, the critical breakout level, sits at $94. That is the line in the sand. Silver just attempted to clear it with conviction. The critical question now is not whether $94 was reached. It was. The question is whether the Monday Open, the first tradable session after this weekend's military escalation, sustains above $94 and pushes toward the next resistance cluster. Analysts note that a decisive daily close above $95 activates the path toward $100. And $100 is not just a round number. It is a battlefield. It is where momentum traders enter, where algorithm triggers fire, where retail investors who sat on the sidelines for 6 months finally capitulate and buy. The coiled spring has been released. The question is how far it travels. According to market intelligence trackers, the gold-silver ratio compressed to approximately 57-1 during the February 28th session. Historical analysis shows that when the ratio falls toward 50-1 or below during periods of sustained geopolitical pressure, silver enters a leadership phase, a regime where it outperforms gold on a percentage basis for weeks or months at a time. That compression is happening now. The ratio is speaking. Are you listening? Here is where the battle becomes physical. Not paper. Not derivatives. Physical. The event that ignited February 28th was confirmed by multiple defense intelligence sources. 2 coordinated military operations launched simultaneously, codenamed Operation Epic Fury by the United States and Operation Roaring Lion by Israel, targeting military command and control, facilities, air defense infrastructure, missile production sites, drone launch positions, and nuclear-linked operational nodes across Tehran, Isfahan, Qom, Karaj, and Kermanshah, according to reports. Approximately 200 Israeli Air Force fighter jets struck 500 military targets in the opening wave. The operation is described as massive, ongoing, and expected to continue across multiple days. Iran responded within hours. According to intelligence reports, ballistic missiles and drones were launched toward U.S. military positions in Bahrain, Qatar, Kuwait, Saudi Arabia, and the UAE, as well as Israeli territory. The Houthis announced resumption of Red Sea shipping attacks. The Strait of Hormuz, through which approximately 20% of global daily oil supply transits, entered direct threat assessment territory. Now connect this military reality to the physical silver market. Iran's retaliatory posture creates a Strait of Hormuz disruption scenario. Analysts note that any meaningful interference with Hormuz flows, carrying roughly 20% of global oil, would apply immediate upward pressure to crude prices, well beyond $80 per barrel. Reports on February 28 cited Brent crude climbing 15% or more in response to the strike development, according to market intelligence. A sustained $100 oil environment creates stagflation mechanics. Inflation rises, central banks hesitate to tighten, real yields compress, and non-yielding hard assets like physical silver become structurally more attractive to every category of buyers simultaneously. But the physical demand floor was already under construction long before February 28 ever arrived. Sources confirm silver entered this geopolitical storm with 6 consecutive years of global supply unable to meet global demand already in place. The 2025 shortfall reached approximately 95 million ounces. The 2026 projected deficit stands near 67 million ounces, according to institute-level projections. Mine supply is essentially plateaued at 813 million ounces annually, with new greenfield projects requiring 7 to 15 years from discovery to first pour. India, which absorbed nearly 190 million ounces of physical silver in 2025 at a total import value of approximately $9.2 billion, operates a government-mandated solar procurement program, targeting 500 gigawatts of renewable energy by 2030, analysts note. Every solar panel requires approximately 20 grams of silver paste. India mines zero domestic silver. Every ounce must be imported. That buying machine does not pause because missiles are flying over Tehran. It accelerates. Because higher oil prices increase Indian energy import costs, which intensify the urgency of domestic solar build-out, which demands more silver. Reports indicate that J.P. Morgan Global Research had projected the physical silver deficit reaching 245 million ounces in 2026, with silver averaging $81 per ounce as its annual forecast. That $81 average was established before February 28. The full-year 2026 average now requires dramatically higher numbers in the remaining months to approach anywhere near $81, meaning the forward price expectation has been structurally repriced upward by a single afternoon of military action in the Persian Gulf. The physical demand floor is not a theory, it is a wall. And that wall just got reinforced with a new layer of geopolitical concrete. There are 2 kinds of people in the silver market on February 28, 2026, the tourists and the diamond hands. The tourists bought the January all-time high at $121.62. They saw the headlines, they saw the forums screaming triple digits, and they bought into euphoria. When silver corrected back towards $71.76 in early February, those tourists sold. Some of them sold at $80, some sold at $75, some held until $85 and sold the day silver was rebuilding its base. They are gone now. Their ounces transferred from weak hands to strong hands, from impatient hands to patient vaults. The diamond hands accumulated between $71 and $87. They did not sell when forums declared the rally dead. They did not sell when analysts wrote that substitution trends would erode industrial demand over years. They watched. They held. And on February 28 they received 7.67% in a single session, their largest single-day reward since January. Now examine the broader sentiment environment. According to market data, the Dow Jones Industrial Average dropped 1.3% in the prior week. The S&P 500 slid 0.4%. The Nasdaq declined near 1%. Equity markets went into the February 28 weekend already stressed. Then 2 coordinated military operations launched in the early morning hours of February 28, according to reports. Stock futures are expected to open lower Monday. Nasdaq futures face additional pressure from institutional rotation out of AI equities into long-duration hard assets, analysts note. When equities bleed, and when oil spikes, and when the world's 4th largest crude choke point faces an existential threat, institutional money moves, not toward crypto, not toward bonds paying negative real yields, toward gold, and then because of silver's higher beta nature, toward silver at an even sharper percentage acceleration. According to settlement data, gold advanced 1.75% on February 28 to spot levels around $5,275.82. Silver advanced 7.67%. The beta advantage, silver delivering more than 4 times gold's percentage return on the same day, is exactly the mechanism that brings institutional rotation when geopolitical risk enters sustained elevated territory. Smart money is not selling $94 silver on February 28. Smart money is calculating what Monday's gap-up opening means for their positioning. Analysts expect a gap-up opening for precious metals when markets resume Monday. Sources confirm. The question is not whether silver opens higher. The question is whether it opens at 95, 97, or whether a sustained Hormuz disruption signal before Monday's session pulls it through 98 or higher before the first retail trade is placed. The sentiment shift is also visible in India. According to market data, MCX silver futures for the March 2026 contract were trading near 279,000 rupees per kilogram on February 28. Analysts project that a Monday gap-up could push domestic Indian silver toward 300,000 rupees per kilogram if COMEX silver rate breaks and holds above $95 per ounce. India's physical silver market, which absorbed 25% of global supply in 2025, wakes up Monday morning to news of active war in a region that supplies over half of India's crude oil imports. The psychological urgency of that combination accelerates physical buying behavior that was already structurally mandatory under the government's solar mandate. Let us talk about what was happening in other asset classes while silver was constructing its 7.67% single-session advance. Bitcoin advocates spent the prior week insisting that digital assets were the ultimate safe haven, that crypto offered the cleanest hedge against geopolitical dislocation, that fiat currency debasement made decentralized tokens irreplaceable. Then the military strikes launched, Nasdaq futures dropped, crypto markets correlated to risk appetite, not to geopolitical safety, came under pressure alongside equities. Silver went to $94.30. The divergence is not subtle, it is the market speaking with full volume. The tortoise versus the hare dynamic plays out in real time on days like February 28. For months, the hares, the crypto maximalists, the leverage traders, the speculative retail momentum chasers were telling anyone who would listen that physical metal was a relic, that silver was too slow, too industrial, too boring for the modern portfolio. And then coordinated strikes across 5 Iranian cities in a single morning reminded the entire investment world what actually functions as a store of value when the world fractures. According to settlement reports, gold advanced to approximately $5,278 per ounce on February 28, its highest level since the January record, and analysts immediately began discussing the potential for $5,300 resistance to be cleared if the military campaign extends into a multi-day operation as Trump described. Silver delivered over 4 times gold's percentage return in the same session. That is the beta advantage playing out in pure form. Now consider the contrarian argument being floated by those who want you to sell. They say this is a fear trade. They say fear trades reverse. They say once diplomatic channels reopen, once ceasefire talks begin, silver retreats. Here is the answer to that argument. According to diplomatic intelligence compiled by open-source monitors, before the first strike fell on February 28, Oman's foreign minister had already announced significant progress in negotiations, that Iran had reportedly agreed to full IAEA verification, and to never stockpile enriched uranium. Diplomatic progress was not enough to stop the operation, because the operation had been planned for months and was timed to a 10-day deadline. The coiled spring of military planning released regardless of diplomatic momentum. What this means for silver is critical. The geopolitical risk premium that entered the market on February 28 is not temporary fear. Reports indicate a multi-day, potentially multi-week operational horizon. Sources confirm the operation is expected to continue across several days with the stated objective of destroying Iran's missile industry, annihilating its naval capability, and eliminating its path to nuclear weapons. Sustained multi-day military operations maintain sustained elevated risk premiums. The physical demand floor, already reinforced by 6 consecutive years of structural deficit, India's mandatory solar procurement program, AI data center consumption, and COMEX registered vault dynamics, now carries an additional permanent layer of geopolitical risk premium. Physical silver in a vault does not care whether a ceasefire is declared next week. The deficit that exists today still exists next week, whether the guns go silent or not. The contrarians are looking at a temporary spike. The diamond hands are looking at a permanent structural repricing. Here is the battle plan. 5 levels, 2 scenarios, 1 directional bias. Level 1, the absolute foundation, $80 per ounce. According to multiple technical analyst assessments, this is the structural floor identified as the next major support below the primary defense zone. The fact that silver accelerated through this level to the upside without ever retesting it from February 27 forward is a sign of structural demand dominance. This level is now deep support. If the entire military escalation somehow reversed overnight, which all available intelligence suggests is impossible given the stated multi-day operational commitment, and silver corrected dramatically, $80 is where physical buyers would absorb every ounce available. Level 2, the primary defense line, $93.83, the February 28th spot settlement. This is now the floor that Monday's session must hold above for the breakout thesis to remain intact. A close below $93.50 would suggest the futures spike was partially a weekend gap that Monday's institutional flow has not confirmed. Watch this level on Monday's open with full attention. Level 3, the activation gate, $95 per ounce. Analysts note clearly that a sustained hold above $95 activates the momentum trader entry. Algorithms trigger, retail urgency begins, and the advance toward $100 becomes the base case rather than the optimistic scenario, sources confirm. Watch $95 like the line in the sand it is. Level 4, the psychological battlefield, $100 per ounce. This is not a Fibonacci level. It is not a technical pattern target. It is a psychological detonation point. The moment silver trades above $100 on COMEX, the financial media cycle ignites. Mainstream publications write the headline. New retail buyers enter. Institutional desks that have been waiting for confirmation of sustained triple-digit silver add to positions. The self-fulfilling mechanics of a psychological breakout take over. According to reports, Citi's second half 2026 target of $110, citing acute physical shortage for immediate industrial delivery, suddenly looks conservative rather than aggressive. Level 5, the measured move target, $121.62, the January 29th all-time high. If the current geopolitical escalation drives sustained physical demand accumulation, if the Strait of Hormuz disruption materializes, and oil holds above $100 per barrel for more than 2 weeks, if India's Monday gap-up opening creates a domestic shortage signal that accelerates sovereign purchases, then the January all-time high becomes the retest target, not a guarantee. But the scenario architecture exists for the first time since late January. Scenario 1, sustained military campaign. Operation Epic Fury extends beyond the initial weekend. Iranian retaliation continues across multiple Gulf targets. Oil holds above $90 per barrel. Silver gaps above $95 Monday open. Physical buyers absorb every available ounce. COMEX registered vaults face renewed delivery pressure. The advance toward $100 is confirmed within 5 trading days. According to operational intent statements, this is the base case given the stated multi-day mission parameters. Scenario 2, ceasefire signal within 72 hours. Oman or another mediating power broker's emergency ceasefire. Silver pulls back toward $88 to $90 as risk premium compresses. Physical demand machine absorbs every ounce at $88 to $90 because the structural deficit has not resolved. Diamond hands treat the pullback as the back up the truck moment. The advance toward $100 resumes from a lower base. Both scenarios lead to the same destination. The only question is the route and the timeline. Now the question I need you to answer in the comments. Do you believe silver clears $100 before the end of March? Let me know below. This is Analyst here. The trap was set in early February at $71.76. The spring was compressed through 27 days of consolidation. February 28th released the mechanism. The weak hands are gone. The diamond hands are holding. Stack now, stay sharp. See you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.